Ever wondered what assets rich people hold instead of cash? Well, you're not alone. The asset portfolio of the wealthy is a topic that garners great intrigue. You see, wealth building isn't just about hoarding money, it's about diversifying assets and making strategic investments. When you think about the rich, you might imagine piles of cash. But in reality, the wealthy prefer to convert their cash into assets that can grow over time. These assets often fall into 5 main categories. Firstly, there's real estate, a tangible asset that has the potential for significant capital appreciation. Then we have stocks, bonds, and mutual funds, all forms of financial assets that offer returns and diversification. Lastly, we have business ownership, creating, investing in, or buying businesses, which can yield substantial returns. Are you ready to dive into the world of the wealthy and explore these top assets? Buckle up. The first asset on our list is real estate. Now, when we think of real estate, it's not just about buying a house to live in. It's about investing in property that can generate a steady stream of income and appreciate in value over time. Real estate investments come in many shapes and sizes, each with its unique advantages. The most common types are residential and commercial real estate. Residential real estate includes properties like houses, apartments, and townhomes, which are rented out to tenants. This type of investment is popular because it provides a consistent monthly income from rent, and the property's value can increase over time. On the other hand, commercial real estate involves properties used for business purposes, such as office buildings, shopping centers, and warehouses. These properties often come with longer lease agreements, providing an investor with a more stable income over a longer period. Plus, commercial properties are often valued higher than residential ones, leading to larger capital gains when sold. Now let's talk about the advantages of real estate investments. One key benefit is the potential for passive income. Once you've acquired a property and found tenants, you can sit back and enjoy the rent money rolling in every month. Another advantage is capital appreciation. Over time, the value of your property can increase, and if you decide to sell, you could make a substantial profit. Moreover, real estate investments are tangible. You can see and touch your investment, which isn't something you can say about stocks or bonds. This tangibility can give investors a sense of security and control over their investment. Additionally, real estate can provide a hedge against inflation. When prices increase, so does the value of real estate and the rent you can charge tenants. This makes real estate a good option for preserving wealth in times of rising prices. In conclusion, real estate investments offer a wealth of opportunities for income and growth. Whether you're interested in residential or commercial properties, the potential for steady income and capital appreciation is there. Real estate, providing a tangible, profitable asset that offers steady income and potential for growth. Moving on to the second asset, let's talk about stocks. So what are stocks? In the simplest terms, stocks are shares in the ownership of a company. When you buy stocks, you're buying a piece of the company, a claim on its assets and earnings. Now, how do stocks work? When a company decides to raise funds, it can do so by selling stocks to the public. This process is called an initial public offering, or IPO. Once these stocks are sold, they can be bought and sold on the stock market. The price of each share fluctuates based on supply and demand dynamics, the company's performance, and broader market sentiment. But here's the exciting part. Stocks can help generate income in 2 primary ways, through dividends and capital gains. Dividends are portions of a company's earnings distributed to shareholders, usually on a quarterly basis. Capital gains, on the other hand, are the profits you make when you sell a stock for more than you paid for it. So, why do wealthy people invest in stocks? Well, stocks have the potential for high returns. Despite the risks, the stock market has historically outperformed most other investments over the long term. But here's a word to the wise: diversification is key. This means spreading your investments across various stocks from different sectors. You see, not all stocks will perform well at the same time, and diversification reduces the risk of losing all your investment if one company underperforms. However, it's important to remember that investing in stocks is not without risks. The stock market is inherently volatile, meaning prices can rapidly increase or decrease for a host of reasons. But as the saying goes, no risk, no reward. All in all, stocks are an excellent way for investors to grow their wealth over time, provided they're prepared to weather the market's ups and downs. Stocks, a volatile yet potentially high-yield asset, offer a piece of company ownership. Third on our list are bonds. Now, bonds might not be as glamorous as real estate or stocks, but they hold their own charm and benefits, especially to those who prefer a safer and steadier approach to wealth building. But what exactly are bonds? In the simplest terms, when you buy a bond, you're essentially lending your money to an entity, be it a corporation or a government. It's like becoming a mini banker, if you will. They promise to pay you back the initial amount known as the principal at a specified future date, or what we call the bond's maturity date. But the real beauty of bonds lies in the interest they provide. This interest, or coupon, as it's often called, is paid to you regularly, usually semi-annually, annually, or at maturity. It's like having a predictable stream of income, which can be quite appealing to many investors. Now, there are different types of bonds, but let's focus on two main categories: corporate bonds and government bonds. Corporate bonds are issued by companies. They tend to offer higher interest rates because, well, companies can go bankrupt, and there's a risk you might not get your money back. On the other hand, government bonds are seen as the safest bonds out there. They're backed by the full faith and credit of a country's government. The likelihood of a government defaulting on its bond payments is generally quite small, especially if it's a stable, developed nation. However, because of their safety, government bonds usually offer lower interest rates than corporate bonds. So you see, bonds offer a balance. They're safer than stocks, providing a regular income stream. But they're not as safe as cash sitting in a bank. The risk is there, but it's a calculated one. Bonds, a safer bet for steady income, are essentially loans you provide to companies or governments. So, next time you're looking for a stable, income-generating asset, remember bonds. They might just be the steady player you need on your wealth-building team. Next up, we have mutual funds. A common term, yet often misunderstood, but don't worry. We're here to take the mystery out of mutual funds. Mutual funds are essentially a pool of money collected from many investors, like you and me, that is managed by a professional known as a fund manager. This pool is then invested in a variety of assets, such as stocks, bonds, or other securities. This strategy offers investors an opportunity to hold a diversified portfolio even if they don't have a large amount of money to invest. Think of it as a basket of various investments. Instead of buying a single apple, or stock in this case, you're buying a little bit of many different types of fruits. Each fruit or investment carries its own set of risks and rewards. But the hope is that the overall basket remains healthy and grows over time. Fund managers play a critical role in the functioning of mutual funds. They are the ones who decide where to invest the money, based on their expertise and understanding of the market. They continually monitor the market, make buy and sell decisions, and adjust the portfolio as needed to try and maximize returns for investors. The potential for returns in mutual funds can be quite promising. The diversification helps to spread out risk, meaning if one investment in the fund doesn't perform well, others may still thrive. Remember though that like all investments, mutual funds also come with their own set of risks, and there's always the possibility of losing money. One of the great things about mutual funds is their accessibility. They are available to all types of investors, whether you're just starting out or have been in the game for a while, and with the variety of mutual funds available, there's likely one that fits your investment goals and risk tolerance. So there you have it, mutual funds, a basket of various investments managed by professionals, a way to potentially grow your wealth, diversify your portfolio, and have your money professionally managed all at the same time. Finally, we reach the fifth asset: business ownership. Running your own business isn't just about being your own boss. It's about owning a significant asset that can generate a steady stream of income and potentially appreciate in value over time. This asset isn't just about profit margins or revenue. It's about creating something of value that serves a purpose and fills a need in the market. It's about building a brand that stands the test of time and keeps customers coming back for more. Of course, owning a business isn't all smooth sailing. It comes with its fair share of challenges: managing employees, navigating market changes, balancing budgets. But the rewards can far outweigh these hurdles. From the freedom to make your own decisions to the satisfaction of seeing your vision come to life, business ownership offers a unique blend of benefits. Business ownership, a demanding yet potentially highly rewarding asset. To recap, we've explored the top 5 assets that rich people hold instead of cash. Firstly, we delved into the realm of real estate investments, the tangible and often high-return asset that many of the wealthy swear by. Next, we delved into the world of stocks, ownership shares in companies that offer both growth and income potential. We then moved on to bonds, the debt instruments that offer predictable income and are a favorite among those who value stability. Following this, we discussed mutual funds, a popular choice for diversifying investment portfolios and spreading risk across a wide range of securities. Lastly, we took a look at business ownership, an often overlooked but potentially highly rewarding asset. Each of these assets offers its own unique benefits and risks, and the key to wealth building lies in understanding and strategically investing in them. Remember, true wealth building involves diversification and strategic investment in various assets. Now it's your turn to build your wealth like the rich.